So we'll begin.
So are we waiting for any more people to join or should we start?
Yeah, we can start now. As we are recording this conversation, so we can always put it on our YouTube channel, and anyone who wishes to see can check it out. Okay, so we'll begin, right? Hello, everyone. Welcome to this IIFL webinar with the management of CMS Info Systems. Today we have with us Mr. Punit Kokuru, who is the Senior Director, Corporate Lead, and Mr. Sumit Bansali, who is the Associate Director, Corporate Strategy at CMS Info. Mr. Punit, I would just like to request you and Sumit ji to just give a brief to our viewers about your company and the business that it is in. Maybe you can run through the presentations that you have for us.
Sure. Thank you, Jayesh, and a warm good evening on behalf of the company to all who have joined on this Monday afternoon. I think a particularly good day for people in the capital markets, at least this is how the indices and the stock markets have moved. So without further, Jayesh has already introduced us, so we look at overall corporate strategy, investor relations, M&A for CMS, and what we will do is just take you through some pages over the next 10 minutes to give you context, background on the business, what we do, how our performance has been, and the way forward. So quickly jumping into the company. So CMS was formed in 2009, which was when our current CEO, Mr. Rajiv Kaul, who formerly was the head of Microsoft in India and led emerging markets for them globally, partnered with a private equity to carve out some businesses related to IT infrastructure, business services, and allied services for the banking sector. And in 2009, what we inherited was a multi-service business IT services company. And through the next 4 or 5 years, what Rajiv, led by Rajiv and a fresh management team that was hired, what did was created a very strong position, market leader in the cash logistics space in India. This was actually coincided and overlapped with the first wave of private banking sector outsourcing that happened, which was comparable to how it happens globally. What we also saw was both public and private sectors driving the first real wave of growth between 2010, 12, 13 in expanding physical networks. And as they expanded branches, they were adding even more ATMs. So they were adding more ATMs, they were increasing their branch network, which meant they needed to outsource 3 parts of this value chain. It created a very attractive market. So different parts of the ATM value chain, which is managed services, cash logistics, ATM equipment providers, and other service providers, they all jumped and entered the space. We, by creating strong leadership in our physical distribution network, which is what is core in any logistics business, and added a layer of technology and processes, which is very critical when you look at us doing high value logistics. Risk management becomes very critical. So by 2015, we had created a company which had moved from being an IT plus business services to a core cash logistics company. Not just number 1 in India by a wide margin, but also one of the top 5, 6 players globally. We had done this through, as I said, investment in deep corners of the country, in having a technology first approach versus how incumbents would have been, because most of the management leadership came from technology sector, consulting, and other industries instead of being from a logistics industry. 2014-15, once we created this core, created a what you would call a cash flow generating engine, because once you've created a network, you don't need to invest. So there is a very low maintenance capex requirement here. So took it to the next level, and that is when we started getting into adjacency. We strengthened our leadership, got in more experts, and between 2015 and even if I were to say 2021-22, what we did was every 18 months or so, we were launching a new business, new capability. Now, when you look at this, these 6-7 years, these have been marked by one crisis after another, not just for the company or the industry we are in, but for the wider economy, whether it is the NPA crisis, demonetization, PSU merger activity, RBI bringing in new operating standards and regulations for our sector, and then the COVID pandemic, which at least had a lingering impact for at least 2 years in consumption and banking sector. So what he did was in that second wave, which was when the overall industry outlook was sort of moderate, we got into new services and capabilities. This was done both by hiring people and building capabilities in-house, but also doing a very structured, value-oriented M&A where we acquired small companies, small technology businesses, and then incubated larger businesses on top of them. So to the extent that when you look at 2023 today, we have two large business verticals, and Sumit will talk about these. There is cash logistics and managed services and technology solutions. So from being almost 100% cash logistics, today our managed services, the services business and our managed services and technology solutions, that accounts for almost 38% of our revenue. So we've created large profitable pools and expanded our TAM over the last 5-7 years. And most recently, and this is more present continuous tense, is the wave of branch expansion, physical network expansion is repeating what had happened about 10 years ago. Also because 10 years is also a cycle for refresh upgrade. And we again see, and I'm sure you read about HDFC, SBI, ICICI, Kotak talking about not only growing digitally, but also growing physically. So that, along with the fact that now all PSU banks have consolidated, it is a smaller, large set of larger players. They are now able to do smarter outsourcing. A smaller regional bank wouldn't have been able to do, for example. And now we see this renewed wave of consumption growth, push for organized retail, because all the regulatory infrastructure has been created, right? So there is obviously DBT coming into accounts, there is GST implemented, so that creates a more formal, organized consumption value chain. So I will just and before we get into the businesses, would actually want to say that was just theory in terms of us saying you're a cash logistics company to become a broader business services company working with every bank of repute and addressing more than working with around 2,000 plus retail brands. What is essentially we want to highlight is that in these 14 years of journey of the company, despite multiple macroeconomic and industry cycles, the businesses that we continue to build and grow, and this is largely through internal accruals after the initial priming came into the company, we have actually compounded at nearly 10x in terms of revenue and at a higher rate when it comes to EBITDA and profitability, largely driven by operating leverage, technology, and new high-value businesses that we run. So over a large cycle, which is almost 2 economic cycles, that is what the team and management team, the execution, and the platform has been able to deliver. We'll just break down now, get into what we do, because multiple businesses, wide-ranging capabilities.
Talking about businesses, we have two large businesses. The biggest one is obviously the cash logistics space, which we had started probably somewhere in 90s, and then slowly scaled up since then. Cash logistics approximately contributes close to 62% of our revenue. The key point to note here is the cash logistics are probably 100% of our revenue 6-7 years back, and due to scale up of managed service and tech solution business, the contribution has kind of reduced now. Cash logistics business is all about kind of moving the currency through physical currency through the cash value chain in the country. If you look at the cash value chain in the country, the currency value chain in the country, it starts with RBI printing currency and then moving it to bank currency chest. Our first service, which is cash in transit, kind of help bank move bulk currency between currency chests to bank branches or between currency chest to currency chest. This is more like helping banks for to around bulk movement of currency. So the way the currency cycle works is that once the currency is moved from currency chest to banks, it needs to be moved to ATM for replenishment, where it is used by where it is withdrawn by consumers for expenditure. So the second leg of the currency cycle is helping banks move currency from bank branches to ATMs, and there we kind of provide ATM cash management services. Here we, along with ATM cash management, we also along with replenishment currency, what we also do is something more like first line maintenance. doing an end of day reconciliation, reporting of the physical currency present there, etc. Once the currency is withdrawn from ATMs, it is spent at points of consumption. And that's where we help mop up the currency back from the economy to the bank branches. The third service, which is around mopping up a currency from from economy to bank branches, is called as retail cash management. The key point to note here is that all the activities are kind of done on a single common network, which helps us have a very high operating leverage in the business. Talking about revenue models of this business, the revenue model for ATM is very straightforward. It is more like the number of touch points into per point realization. The per point realization here is a function of number of activities we do. It's not a function of the amount of cash replenished or the amount of cash withdrawn from ATMs. Almost 90-95% of revenue is fixed. As of March 23, we were doing approximately 72,000 ATMs, which has scaled up from 52,000 almost 3-4 years back. So we added almost 20,000 odd ATMs over the last 4 years. ATM cash management is a larger piece of the cash logistics, contributes approximately 60% of the cash logistics revenue. The second bigger piece over here is retail cash management. As I told you, we help retailers move currency from their stores back to bank branches. Retail is kind of a misnomer here. We don't only work with retail chains, we work with all the points of formal consumption. We work with NBFCs, we work with hospitality chains, we work with hospitals, we work with e-commerce depots. So wherever the cash gets accumulated, we kind of help move that currency back to bank branches. Here also, the way the revenue model works, it's a function of number of touch points we serve, and what we charge is a per point realization. The per point realization is a function of the daily cash limit which the retailer has subscribed to. Almost 70-80% of revenue here also is fixed. Only 20% of revenue is linked to the volume of currency we handle. So if you look at both the businesses, ATM and retail, both are linked to number of activities. They have a very limited beta to volume of currency carried. That in a way makes almost 80-85-90% of revenue fixed. The third business which we have around is moving bulk currency from bank branch to bank branch or from a currency test to bank branch. The way the revenue model here works is we charge banks a fixed amount for fixed number of kilometers and fixed number of hours during a month. In case the bank kind of exceeds those kilometers and hours, we charge them a variable amount. Here also there is no linkage to volume of currency handled. The contract here are long-term in nature. Typically, they range between 3 to 5 years. It gives a very high degree of visibility. So I just want to take a 1-minute pause here in case anybody has any questions to the cash logistics business. We can take it here. We can come back for any specific questions.
What I would suggest is we can run through the presentation, and post the presentation is done, we can start up with the Q&A. So we have already received 4 or 5 questions.
Sure.
So yeah.
Are you okay with the pace? Are we going too fast?
Yeah, we are okay. It's okay.
Sure. The second business which we have is, in a way, providing end-to-end service around ATM management. So you might move into an SBI ATM. There everything might be done by CMS, right from the ATM deployment to ATM management to remote monitoring to the software which is used in that ATM. So in a way, we are an end-to-end service provider for this business for ATM form factor. So the business, this business is referred to as managed service and tech solution. The key point to note here, the business was almost zero in 2015-2016. Over last 6-7 years, this has scaled to almost a run rate of 700-800 crores from scratch. So there are 4 broad businesses under which are housed in the managed service and tech solution. The first one is obviously banking automation, where we kind of help banks with automation products like ATMs, recycler, passbook kiosk, and then we also help bank with AMC and maintenance over the life cycle of the product. Here, the revenue stream is upfront product revenue plus associated AMC for the life cycle of the product. So, the associated AMC kind of provides a revenue visibility over a longer period of time. The second business which we have here is ATM as a service. Here, what we do is help banks manage ATM either on our capex or on bank capex. We do approximately 15,000 odd ATMs. We do approximately 15,000 odd ATMs as of March 23, out of which almost 60% is on asset-light model where the capex is done by banks and we help them manage the asset. The rest 40% is on our books, which is called as the ground level ATM model. The only business out of the 7 which we talked about, which is linked to transactions, is the ground level ATM piece, which contributes approximately 15% of our overall revenue. The third business which we have is providing software for ATMs. Here we have two major software solutions. First is the Windows, MBS software, Algo MBS, which we call as MBS Algo. It is more like an operating system for ATM. Here we did a large project for SBI a few years back, where all the SBI ATMs were kind of switched to MBS software. The revenue model is very simple. It's more like upfront license plus associated AMC and maintenance fee over the life cycle of the contract. The last business under managed service and tech solution, remote monitoring, which we entered in 2021 through a small acquisition, and it is scaled up to approximately 100 crores revenue run rate, annualized revenue run rate as of the last quarter. Yeah, what we do is we use AI in helping banks manage their ATM and ATMs in providing several solutions to banks for their ATM and bank sites.
So in terms of now you understood the businesses, just wanted to highlight that on our cash logistics business, we are today serving 16,500 pin codes. So when you look at some of the largest logistics companies in the country, like a delivery, so our reach is comparable to those. And we are every day doing either ATM replenishments, retail cash pickups, movement of currency, services. So that is sort of the scale and scope of our networks. We are 2/3 of the ATMs that we work on are in semi-urban rural India. And as new ATMs get added, obviously we are already present there serving those. The mix towards managed services, technology solutions, particularly software and IoT-based remote monitoring, also means we now have these longer-term recurring revenue pools, which are where there is no exposure to any transaction risk, etc. Now, how all of this evolution of the business and growth in the market is that despite COVID for over the last 5 years, despite having COVID impact at least one full year financial year, we've grown our revenues at 14% compounded. Now, if you look at the 1 year prior to COVID, we grew almost 20%. The 2 years post-COVID, we have then grown at 20% plus. Now, what is more important to note here is that our EBITDA profitability, right, whether at an operating level or a net profit PAT level, has grown faster. Now, that is the nature of what we talked about, right? An integrated network, use of technology. We've also done tactical acquisitions where we've been able to extract operating efficiencies or synergies from those, which have actually created sustainable margin improvements. New businesses, higher margin, and technology solutions also mean we are continuing to improve as the mix changes. So what you see is a strong revenue growth compounded even faster basis the nature of the business and how we are gradually moving to more efficiency using more technology, which is what you see. PAT margins, for example, as a percentage have nearly doubled from 8.5% to 16%. Now, what is I think more important here as investors for you is it one shot, is it right luck? But when you look at these numbers at a more granular level, which is quarter on quarter movement, very gradually, you will see that this growth has sustained. In fact, when we look at our PAT over the last 11 quarters, which is roughly our which includes our listed journey plus a year, you will see that there are 10 out of those 11 quarters we have grown our PAT by at least 20% on a year-on basis. And in fact, there have been periods when the growth has been significantly higher than that. So that's the kind of sound business on top of which we are able to generate revenues. We are market leaders in most of the segments we operate in. And but what is also critical and what we'd like to highlight is that if you look at our numbers in terms of high EBITDA, that converting that and generating operating cash flows from that, we have consistently, on an average over the last 4 years, we are at 65% plus. And what that means is there is significant cash flow generation. What that also means is we need to be very judicious in redeploying those. And if you look at how we have our track record has been last 2 years, financial years, FY22 and 23, we invested significantly last 3-4 years. And we have been very careful in terms of understanding when banks are expanding, when overall there is more focus on expanding networks and outsourcing. And that is when we drive investments, whether it is expanding our logistics network or working with banks and helping them expand their footprint, right? Deploying capex on their behalf. Or in IoT, where we invested in building, acquired a small company, invested in building the technology, and now have taken that business, scaled up that business much bigger. We continue to be dividend paying. Even as a private company, we had a strong track record of paying dividends. We have continued to demonstrate that in terms of the payout rates. Despite making these investments, despite on a growth phase, what we have delivered is a strong ROE generation, which essentially means whatever incremental investments we make sure they are above our historical threshold, so they're not diluting those. Today we sit very strongly. As of March 23, we were sitting at about 450 crores plus of liquid cash on our books. We are a net debt-free company, AA plus credit rated. Right, for our cohort and size, we would be in the top 1 percentile of those companies. What that means is we have significant dry powder as we look at banks expanding their network, outsourcing, and also have an optionality to invest more and evaluate and take measured bets on new opportunities that are beyond cash logistics, beyond the ATM infrastructure value chain. For example, the IoT remote monitoring takes us beyond that, and continue to see what the CMS platform, which is logistics, risk management, technology for banking sector, all of this together, right, IoT, how this can actually be used to deliver more services for banks, which today we are not offering. And when I talked about the dry powders for the strong growth opportunity, there are very strong, we are at that cusp of that cycle, right? When banks look at expanding and building in cash logistics itself of 2.6 lakh ATMs in the country, 1 lakh are yet to be outsourced for cash management. So that creates a large pool of opportunity for us. An even bigger opportunity pool or addressable market is the retail sector in India. I'm sure you track the organized retail sector and how it has grown post-COVID. That creates a decade-long opportunity because every organized retail touchpoint needs a cash and a treasury solution, which is what we offer to large organized retail chains, microfinance companies, insurance companies, utility bill payments. As the utility infra gets privatized and outsourced, that again creates larger opportunity. Just on the managed services portfolio of services that we have, where we provide banking automation products, we do end-to-end management. What we see is the refresh cycle, the expansion cycle repeats almost every 8 to 10 years. And if you look back publicly available data and what we also talked about upfront, there was a large expansion cycle that happened about 10 years ago. So all of that is up for refresh expansion. Public sector banks are, and this is public information, talking about ICICI, HDFC, and a few others are talking about adding about 10 to 12,000 branches over the next 18 to 24 months. You would have seen how HDFC has been very aggressive in building CASA. And what that means, and historically that has been the ratio, for every 1 branch you add 2 ATMs in the branch and in the vicinity. And banks are continue to maintain this. On top of this, all these ATMs, 80,000 refresh, 20,000 new, they all are now getting outsourced through smarter deals instead of things being done in-house or through very discrete outsourcing. And we are one of the few players, not just in India, but probably the only player, not just in India, but globally, that can do everything in-house under one roof. We have engineering, logistics, software, all under one roof to offer. IoT remote monitoring, today we are a market leader in the ATM and bank branch ecosystem, so we call it the banking ecosystem, but there are enough global analogs and use cases that have a potential in NBFC, insurance, retail, warehousing and transportation sector, and we continue to use it. So as we created a large 40 use case AI library, which monitors people movement, crowding, safety, security, for an ATM and a bank branch, there are use cases that we are building for other sectors. So that obviously creates opportunity to go beyond. And of course, every 5-7 years, as banks upgrade their networks, as NBFCs upgrade their networks, they want to move from a legacy bought out service to a much smarter remote monitoring as a service platform, which is what we are building and investing towards. Inorganic, I already talked about. We have historically grown through a combination of organic and inorganic growth. We continue to look at doing that. The industry is by nature of it gets consolidated because banks want to work only with a few high quality players. That's the global trend. That creates opportunity for us in the future, and we anyways look at sensible adjacencies to get into as we look at inorganic growth. To just summarize before we sort of move into Q&A, FY21, this was mid of 2021 calendar year was when we went through our listing journey, and that is when we had stated a public goal of doubling our revenues in a period of 4 years, which was from 1,300 crores to about 2,500, 2,700 crores. This is only public guidance we give. In fact, we think as an organization, think long term in periods of 3-4 year cycles. And today we are at mid journey of that from a full year perspective. We are slightly ahead of the curve. That this translates into an 18-19% CAGR. We are at just about little ahead of that curve. So when you look at our medium term targets, we are focused on executing and delivering those. The margin profile, the return profile of the business, the cash flow generation, and the strong balance sheet is something we already talked about, and we'll continue to look at this medium-term target. There is also a target to also grow our, because we are smaller, our managed services and tech solutions businesses faster, and that you again will see in the mix of businesses. So cash logistics, while it has grown handsomely, the contribution has come down from about 85% about 3 years ago to about 62% in the last quarter when we published our results. Thank you for your time and patient hearing. We will just take the questions now.
Great, Punitji and Sumit, for getting all of us through the presentation. So I would request everyone to post their questions if they have any in the chat box. I do have a few questions, and I have also received some questions from our investors too. So let's begin with the Q&A session. So first question we have received from our investors. So they wanted to know, as in, who are your peers and what differentiates you from them, as in. So can you throw some light on the current order book positions of your company?
Talking about our peers in cash logistics, is the larger piece there. So we are number one across all the three businesses. Each of the businesses has different set of competitors. In ATM cash management, the number two player is Secure Value, who is more like the subsidiary of the listed company Aegis Transact. The second business is retail cash management. The number two is Radiant, which is another listed company. So Radiant and CMS are almost like to like in terms of market share, approximately 35-36% each. And the third business is cash in transit. The second largest player there is SIS. They also have a small business around cash logistics. They are the second largest player there. The key differentiator for CMS, obviously in cash logistics, piece is the network which we have. We have created a network which spans approximately 16,000-17,000 pin codes. It's present across 97% districts. So we are present across the length and breadth of country. For somebody to be able to kind of create that network requires huge amount of investment and time. So having done that, obviously puts us to an advantage. That's one piece. The second advantage which we have is obviously the use of technology which we do for cash logistics. You get a chance to look at our annual report on how do we use technology for optimizing operations. So that creates an advantage for us. The third advantage which we have is obviously having pole position across three businesses, given the fact that cash logistics is a very high operating leverage business. And the cost of operations or the incremental cost of operations for the larger player is much lesser as compared to a smaller player. That gives some amount of inherent advantage. So that's on the cash logistics piece. On managed services piece.
On
you want to add on cash logistics?
Yeah, so on cash logistics, as Sumit said, we are our biggest advantage is we are a large player across multiple segments, right? And in a logistics business, if you are large and you have, because we use the same platform, same technology, same backend, that same crew and infrastructure. So that creates a very big differentiator because the number two in each vertical is a different player. They may different reasons for them not to have been able to scale up in these businesses, and all these need sort of different skills and customer sets. On managed services and tech solutions, again, there is there is for on the ATM as a service business and automation business, there our competitors are actually either payment companies, global payment companies such as Hitachi Payments or domestic payment companies, or what you would call managed services, ATM OEMs like an NCR Corporation or a Diebold next door. So it's a combination of both ATM ecosystem players, automation players, as well as payments and business services companies. So again, it's a reasonably concentrated set. For software, again, there aren't too many people who do that. The multi-vendor software and the other the software suite that we have, there would just be a couple of players doing that. In IoT remote monitoring, again, there is a small set of, it's largely startups that we compete with, a few small venture debt and small sort of self-funded startups that we compete with. And honestly, there isn't much competition because in India, unfortunately, legacy system integrators have been providing this service. It is just that IoT, cutting edge technology based, on demand, on cloud services are now being developed for this industry. So there's a large, and in retail cash management, honestly, again, the biggest competition for us is people doing it themselves, right? Retail stores. There is no option of 6-7 lakh organized retail touch points where we can do retail cash management. Only about 1.5 lakh are doing this. So for us, a lot of competition is creating customer awareness and then creating an opportunity. And nobody does this under one house. Even globally, there are players that only operate in specific segments.
Talking about order book, the order book is more relevant for our managed service and tech solution business. In cash services, what we measure is the number of touch points. The number of touch points have grown at a rate of 10-12% over the last couple of years, primarily driven by increase in outsourcing and the formalization of economy. And the listing. More important than order book is the incremental wins which we had over last 6 months. So we had wins almost 650 crores over 650 crores? 650 crores over last 6 months. The wins are across our banking automation and the asset light managed service business. This contracts will be executed over a period of 3 to 5 years. Even if I assume a median 4 year, so this should lead to an incremental revenue 150 to 160, 170 crores.
Annualized per year over the next 4 to 5 years for a business which did about 200 crores of quarterly revenues last quarter. So I think we just look at the incremental order book wins. We are at 650 crores this year. Last year it was about 950 crores in FY23. First half of FY24 we are at 650 crores.
The key point to note here is that most of the wins which we had in H1 were asset light in nature, won't entail any capex. So the return profile should be better.
Great. So the next question that I have is, since you mentioned about Hitachi, so the sector has seen an increase in M&A activity recently, with the latest being Hitachi and Writer's acquisition. So would this have any impact on our company, and is our company open to acquisitions?
So I think overall it is a good stamp of sort of positive thing for the industry. If there is a large MNC that is betting on this sector, which a lot of people will say who uses cash, or right, people would have questions, but when we look at our throughput numbers, we look at the broader industry and banks adding ATMs. So I think it is a positive sign for the industry that a global strategic is investing in the sector. So I think it works well for the sector. Writers obviously was a relatively smaller player after the big CMS, and then the peers we mentioned, like the number 2, it's a smaller player. So and if Hitachi wants to do they see some synergies there, so it is good. For us, we are always open to M&A. In fact, as I said, right, we have historically done 6 M&A acquisitions. They have been, you can bucket them as large, transformational, new capability building, tuck-in, etc. So M&A is part of our overall growth strategy, and we have done that historically. 6 meaningful M&As done. In fact, IoT remote monitoring is how we got into this. We got a small company that was doing about 2,000 plus sites. We acquired them, got the base technology capability team. We invested more funds. We used our banking network, our engineer network, and today, in about 2.5 years, we took that business to 22,000 sites. So we have taken that business 10x in 2.5 years. So we are more keen on looking at such opportunities and getting new businesses. In our own sector, we are more value buyers if you were to look at that, like we think a lot like public sector value buys. In any capex we do, we look at a reasonable payback period. We have high thresholds for IRR returns. So we will look at M&A, but it has to meet our thresholds of requirement in the future. There are opportunities in our industry, outside industry, but it's about having patience and judgment and knowing the synergy benefits.
Right. As you mentioned about capex, so as in for the next 2-3 years, what is the targeted amount of capex that you guys would be looking at? Since you had mentioned that the industry is growing at a staggering pace. So any plans of capex, and if yes, then how would you be financing it?
Sure. So before answering that question, I'll probably just explain the nature of capex which we have. If you look at our business, the cash logistics piece, the maintenance capex there is very minimal. The most of the capex which we had over the last couple of years was for growth purpose. A lot of investment went into the order book which we had. A lot of investment went into the upgradation and network in line with the compliance guideline. The future capex obviously will be a function of kind of wins we have. From a maintenance capex perspective, the capex requirements are very minimal or not very high, just put it that way. It's very difficult to exact sense of capex, a function of the types of bits we have.
Today, where we are sitting and what Sumit talked about, order book being largely asset light. Last 2 years was about 200 plus crores of capex. This year we had publicly stated about 150 to 175 crores as the guidance for the financial year. But as I said, right, it comes with a disclaimer. If we win any larger orders, we have opportunity, we will obviously, and it meets our threshold, these numbers can go up, but that will also have an impact on our it's growth capital, like it's not maintenance capital. Yeah. So I think we take it actually by the year, but we can caution you saying in the sense that don't look at last 2 years capex and then sort of extend that from a formula perspective, but those would actually be the highest capex we would have done.
Can you throw some light on unbilled revenue, as it is growing at a faster pace than the total revenues over the past 3 years? So can you throw some light on it?
So, I mean, unbilled revenue essentially, largely in any business services, right? What happens is you will deliver your services, and at the end of delivering your services, you will then raise your bill or invoice, right, to the client, right? Bill to the client. And then it goes through the payment process. So, and this is just an accounting treatment of categorizing this part of what you would call receivables. So you call it unbilled revenue. You look at Infosys, TCS and others, you will see, or IT companies, because they deliver, they will share that detail with the customer and then they get paid. So every services company, invariably, unless they are taking money upfront, will have unbilled revenue. Now it could be 20 days, 30 days, 45 days, it varies by industry. Given what Sumit talked about our business model, right? How we earn money is a function of what activities we did, what cash volume we did, largely activities, which means we have to wait for the month to end to know how much we have to charge our customer. And there again, we don't just go and raise an invoice, we share an MIS, there will be clarifications and other things. So that goes through a cycle before we raise a final bill, right, which is due. So that is the nature of unbilled revenue. What also happens is that in some businesses around our services business or managed services, there could be some AMC and related services where we get paid every quarter instead of every month. So it gets accrued for the entire quarter and then we will raise, right? There are some business models where you get paid at the end of every quarter in software licensing, etc. So essentially, if just looking at revenue growth may not be comparable, it is also the nature of revenue businesses is changing. As we see managed services, which is a more complicated service, you will see. So it's a function of mix change and the scale growth also. So it's just the nature of the industry, honestly, and the change in business mix that optically makes it appear that it is expanding.
And if you look at both the AR and the unbilled together, which is has gone on significantly over the last couple of years.
Yes, if you look at the overall, what you would look at account receivable, that you should have gone down. Similarly, what would also have changed is is that if you look at our net working capital cycle, and I think working capital is something that you look at over a longer period, because as an organization you make changes and introduce efficiency, you will see there is a sustainable improvement. I think that's just the nature of the industry, right? Some industries have lower working capital, some are higher. It's just a function of that.
Okay, great, great. Taking a deep dive into the managed services which you just mentioned. So the company's managed services and tech solution business is getting a lot of traction recently, and I think you guys have mentioned that it has a potential to grow at 40%. I think the overall contribution would be like 40% of revenue.
Yeah, maybe
For
28% as of last quarter.
yeah. So can you throw some light on it?
Sure. If we talk about the different businesses which we have under managed services, so what's happening there is that, as Puneet also talked about, almost 80,000 ATMs are coming up for refresh. The typical ATMs have a life of almost 7 to 10 years. A lot of ATMs got deployed during the period of 2014 to 2015. A lot of them are coming for renewal. If you look at the total RFP pipeline which we are seeing there, so the current outstanding RFP pipeline is almost for 15,000 odd ATMs. Out of those 15,000 ATMs, almost 80% are for replacement, 20% are for expansion of the network. That is acting as a primary driver there. The second driver there is obviously as the banks are kind of refreshing their ATM base, they are kind of moving from doing it in-house to outsourcing it completely. The private sector bank has also had outsourced their ATM estate lock, stock and barrel long back. Public sector banks are slowly doing it now as they are refreshing their ATM base. That is also acting as a tailwind there. The other tailwind for our remote monitoring business is India has approximately 2.5, 2.6 lakh ATMs and approximately 1.3 lakh branches. Out of 2.5, 2.6 lakh ATMs, only 90,000 to 1 lakh ATM currently use remote monitoring. So there is a significant chunk of ATM which are still not using remote monitoring and are using whatever either traditional surveillance or are doing it through guards. So as and when those ATMs move from traditional surveillance to remote monitoring, that creates a significant opportunity for us. Also, also in remote monitoring, what's happening? A lot of contracts are coming for renewal, given the fact that those were handed over or those were kind of those are coming to end of their life. As and when those contracts come up for renewal, we are bidding for it and trying to win.
So what you have to also understand is in managed services, we are coming from a lower base. Yes. We have gotten into different segments of this thing. So we got into automation in 2014, we got into managed services in 17, we got into software in 19, remote monitoring in 2021. So there are different levels of evolution. But at an overall level, I think between managed services, cash management, what is also important is that different businesses have their own drivers. So when banks are buying a lot of ATMs, that creates opportunity for the automation business. So incremental market share to gain incremental share is there. When banks are also outsourcing, banks got merged now, right? So a public sector bank has three different merged, 3 banks, they done cleanup. Now they want to do aggregate outsourcing. So that creates another opportunity for our ATM as a service business. So all of these businesses have their own different drivers. As we speak today, I think largely banking sector doing well in having the strongest balance sheet ever in their history and profitability. That is creating a good momentum over the next 2-3 years.
The order is approximately 650 crores. And that's one which we had as a testimony to the robust pipeline and robust outlook which we are seeing currently.
Great, great. We have got one question from our investor. So he's asking, how big is the cash management industries and at what rate do you see the industry growing? And do you see any impact due to digitalization of our economy going forward? As in terms of you see how the UPI payments have been done. Recent reports have been suggested that they are at a record high.
So probably what I'll do is I'll take the second question first. So if you look at our business model in cash logistics, it's not essentially linked to volume of currency we carry. Cash management is a misnomer here. The business model is very similar to a logistics business. Function on number of touch points we serve and the number of activities we do. Look at our touch points. The touch points have grown at a 10% year on year for the last quarter which we had. The number of activities have grown at a much faster pace, probably 17-18%. So that in a way kind of talks about the intensity of work which we are seeing. If you look at the touch points, what's driving those growth? India has approximately 2.5 lakh ATMs. Those have been growing at a rate of 3 to 4% over the last 4 years or 8 years, whatever time period you take. And those 4 to 8 years were probably toughest years for the industry. Which had multiple crises, maybe demo, maybe NPA crisis, maybe GST, impacting the overall growth. In those years also, we had a growth of 3 to 4%. So, assuming the ATM estate in the country keeps going at 3 to 4% rate, the other driver there is obviously the outsourcing. Of the 2.5, 2.6 lakh ATMs, only 1.5 lakh ATMs are currently outsourced for cash management, which is roughly 60%. The outsourcing was probably 50% a few years back. Gradually, it has inched up to 60%. Over some time frame, probably 3 years, 5 years, the outsourcing should gradually inch up to 75%. As banks are kind of coming up with contracts for refreshing their ATM base, they're switching from doing it in-house to outsourcing to third-party vendor. So that in a way is expanding the TAM for cash management.
Right.
Then we obviously have the normal inflation-linked price increase. Talking about retail sector, there the biggest driver is obviously the growth in formalized and organized retail. India approximately has 3 to 4 million retail outlets. Out of those, 6 to 8 lakhs are organized and formalized retail outlets. Out of those, only 1.5 lakh currently use retail cash management. So from a penetration perspective, penetration is very, very low, abysmally low, let's put it that way. As India formalizes, as the organized retail, as the formalized retail group, that should act as touch point. There are talks about everybody, all the offline store looking at expanding the physical presence. Reliance probably wants to add 5,000-6,000 stores in a year. All the e-commerce hubs wants to expand their presence. So that acts as a natural tailwind to that business.
And I think just to add from a broader cash versus digital, if you look at RBI recently published a research paper where essentially they talked about cash versus digital, and they said they will coexist. They see inherent advantages of cash being very seamless, having a store of value, particularly when there is it sort of it again has some sort of inherent value for as an individual, right, to have some balance in cash. In the US, one of the states just passed a law where you cannot force people to pay only by one mode of payment. So they're saying you need to. There were places where people said, "I will not accept cash." There's a law now that says you have to accept cash. So I think people have come around to believe that you cannot just kill one mode of payment. You have to give people options to give different modes of payment. Even digitization initiatives like DBT coming directly into accounts or micro ATMs or UPI, they are actually also driving cash adoption, because when people get money in their bank account, that's only when they withdraw, right? Historically, we got a lot of Jandan account, but there was no money in those accounts. Now they are getting money. We are paying people in our value chain, right, using UPI. They then start transacting in their accounts that they were not using. And latest you may have seen the RBI governor actually did a demo of using UPI to withdraw cash at an ATM. Now our software enabled that for the largest bank in the country. Our sort of team did that. So the regulator also sees a benefit, saying if there is UPI, why don't we use that as a tool to actually let people do cashless withdrawals? If you see, ATM transactions has remained steady where UPI has gone through the roof. So we believe it is one. I think cash versus digital, it's a never-ending debate, but they will coexist. You look at cash on delivery, it is 50-60% in India in e-commerce. So despite multiple payment options at all. So I think we see there is a model of coexistence for different payment modes. On top of that, our business model, as Sumit explained in detail, is not correlated directly with volume of currency. In fact, in the economy, currency in circulation doesn't matter to us. If you think of currency printed as an inventory, the lesser it is, the more it needs logistics, right? It needs to make more turns, right? The inventory turnover needs to go up. So we see that as sort of overall contributing to formal economy than as a competing business.
Cash logistics, we approximately have 40% revenue market share. The market share for different businesses are different. If you look at the complexity of the businesses, ATM is the most complicated one. So obviously the competitive intensity in that business is slightly lesser. So we would be having close to 47-48% market share there. Retail is slightly less complex. So the market share there, the competition there is obviously much higher as compared to ATM. Our market share would be somewhere around 55-36% there. Right. The third business, the cash in transit, given the fact that it doesn't have an inherent operating leverage as compared to other two businesses, it's a little bit more competitive business. The market share there will be approximately 25-26%. The key point to note here is that We are the market leader across all the three businesses, and that acts as a natural advantage to us because we have a common platform on which all the three activities can be conducted. It helps us gain high economies of scale and high operating leverage.
And from a market size perspective, I think there are industry reports that actually talk about those. I think we can sort of refer to those. But from an addressable market opportunity, 5 years down the line, cash logistics is about an 8,000 crore market. Managed services would be about a 15, 16,000 crore market. With after some overlaps, that creates a 20,000 plus TAM for the industry as outsourcing, right? With some assumptions that obviously the risk companies have put. Today we are at a 40% revenue share in the organized market. There is also an unorganized semi-organized market that is gradually getting organized. And different segments are growing at anywhere between 12% to 20%. So there is different segments growing at different rates.
Great. So actually, if you see the way the company's revenue has been growing, so the growth has been at a very staggering pace. I can see that the EBITDA has grown by roughly 11x in last 14 years, as you said. And all these numbers are very remarkable. And I would like to congratulate all of you for building such a good company. And we hope that our investors also benefit by investing in your company. So any closing comments that you have, you can please share, and then we will like to end the call. And I would also like to thank you, Punitji and Sumit, for taking our request and joining us for this enlightening conversation. So any closing comments, and then we will wrap it up.
So I think thank you very much for giving us this opportunity. Hope this helped clarify and sort of both the FAQs and also in terms of some myths around our business and potential business. I think essentially, I think our teams and what I would like to highlight, Rajiv, our CEO, and the core team, the CFO, the presidents of the two businesses, they've been together for 12 plus years. What that means, there is a consistent management with skin in the game, and the execution track record, which you talked about, right, a 14-year journey. So we are essentially a business services platform that from 2009 being an IT business services became a cash logistics because we saw an opportunity, invested in that. Over the last 7-8 years, we again looked at opportunities, executed and invested. I think we will continue to be like that, a business services platform that looks at opportunities for banks and organized sector and then tracks that. If you look at